All right. Welcome to the few, the proud that are still left over in the afternoon session. So let's give you the market in 7 charts, and then I'm going to pass it over to my colleague, John Kingston, to give you an oil and gas report here. So starting off the whole slideshow here with the IOTI, this is the story of demand. We've been talking about trade war, tariff policies influencing demand this year. If you need a chart to screenshot, take a picture of. If you didn't take it during State of Freight, this is the one to screenshot. Erratic, unseasonable demand that has now stabilized, and we look like we may be normalizing. For the time being, anything can happen in this environment. The next chart. For the domestic transportation market, this is surface transportation demand in total. If you are just looking at truckload volumes, you are not getting the full picture, the full story of the freight market domestically. Rail, which is loaded container volumes on the top there in white, has been far more resilient than the truckload market has, because they have been taking that long haul share from trucking, because when shippers are ordering all those imports that you saw on the chart before, they're ordering it way in front of time, giving them a longer lead time to fulfillment. So the rail becomes a little bit more cost competitive in this situation, service competitive as well. And truckload has lost about 30% of its long haul truckload share to the intermodal space. Looking up at the intermodal volume, we're down about 5%, a little bit of economic demand erosion starting to percolate, show up here in the fourth quarter. Now, if we look at this chart here, outbound tender volumes and outbound tender rejection rates, demand is not the only story for freight. Everyone likes to look at demand. It's really easy to understand. It's really easy to translate into revenue. However, that's not the full story, because tender rejection rates, and the white line there, the rate at which carriers reject load requests from their shippers, starting to come up. This is a highly unusual situation. Capacity metrics are coming down. We're seeing supply side dynamics erode. We're seeing demand side metrics erode, and that is leading to a higher rate of rejection. These two moving together is extraordinarily unusual, especially over this period of time. Very slow. Supply side dynamics move much more slowly than demand. Therefore, this market is actually becoming increasingly vulnerable, much more sensitive to any kind of demand shocks that may be coming. We don't see any demand shocks coming. The IOTI supports a very stable demand environment heading into the late part of the year, but tender rejection rates still being able to sustain as demand has come down, especially in that 6% range, tells us that this market is ready for a turn. Now, we go into the OTRI with the spot rates here. The last couple of weeks, we've seen another unusual dynamic in play. Spot rates coming up. You see there at the white line, that's our NTI, our National Truckload Index that aggregates dry van spot rates, coming up here in the last bit. It does not have the support of the tender rejection rate. This can happen, but it tends to be quite short-lived or temporary. But we do think that some of this has to do with all the immigration, regulation, enforcement behavior. Tender rejection rates have come up a little bit more recently. We've got markets like Atlanta over the last day or two that are really percolating. But the market that I'm most interested in this type of environment is Ontario, Los Angeles. This is that long-haul freight that really carriers have not been able to kind of count on coming off the West Coast over the past year, because intermodal has taken a large portion of it. This creates a lot of instability. Now, Craig stated on the State of Freight that, of course, the immigration crackdowns and some of those enforcement behaviors could be contributing to this, and I'm sure that they are in some level. But the story here is that spot rates are a little bit more vulnerable. The spot market is more vulnerable to all of these situations versus the contract market, because the contract market has a little bit more stability in it in terms of an employment standpoint. Let's go to the next chart and break it down into modes. We got to ask this question: what's going on with the other two trailing asset types? This is going to be the tender rejection rate for flatbed. They're in white. That's the one that has the big plateau and stuff going on in the spring. And then you've got refrigerated, which I should have put in blue, but it's in yellow. That's down there. And the yellow that is now leading the way at a 14.5% rejection rate. And then down there at the bottom, trailing the pack as it typically does, dry van rejection rates at about 5.7%. Still relatively soft or loose environment, depending on your perspective. Fairly easy to get capacity. Now, the refrigerated rejection rate has just surpassed the flatbed rejection rate. The refrigerated sector tends to be about 20%-ish of the tender data. It's not as heavily covered by the contract space. Spot markets, spot rates are actually trending almost exactly in line with this trajectory. Refrigerated spot rates are also above flatbed spot rates at this point in time. So this change of the guard, if you will, especially since flatbed is not as well covered in the contract space and certainly tends to be a lot more volatile and less covered in terms of just general capacity availability. Being below this or having this switch here is a little unusual. We saw this during the pandemic because refrigerated and van freight were much more in demand at that point in time. Construction, some of those manufacturing components were shut down because of quarantining. So the flatbed market showing signs of being a little bit softer than it was for the most part, or for the majority of the year, is an interesting situation. The construction sectors, manufacturing sectors that it services, of course, are not having booms right now. We're going into a little bit of an off season as well, but definitely a trend to watch as refrigerated has been a little bit more responsive than the other two modes this year so far. Bringing it down, I talked about Ontario. I wanted to give you guys at least a more granular rate view. Ontario to Dallas is the one I pulled up, and you've got the spot rate from Ontario to Dallas on the green line, and you've got the outbound tender rejection index from Ontario in general, so not just to Dallas, in the yellow line. You can clearly see the correlation here, but I think this is the story of Ontario over the last couple of years, really. This is a 2-year chart, but it's very erratic, and we are seeing over the last 6-7 months this gradual increase of rate and tender rejection rate coming off the West Coast. This has been a very, very soft environment. Look at the spot rate and the rejection rate compared to the previous couple of years. Outside of April of 2023, this is actually the softest environment for freight coming out of Ontario going to Dallas. And it's starting to get tighter and significantly tighter very, very slowly here. So definitely be keeping an eye on Ontario. And then last but not least, it's bid season or starting to do budgets and everything. Contract rates flatlining, spot rates slowly climbing towards them still. The faster this line, though, we've seen that big jump there. I talked about the immigration crackdowns and that spot market vulnerability. We still got a ways to go before it's going to meaningfully impact the contract space because they're still at a discount, but it's not that far away if the market turns quickly, which it can do in the fourth quarter, which would mean contract rate compliance deterioration. And with that, I will hand it over to John Kingston.
Thank you very much. I don't know why they had me up here because I'm going to be boring because the last year of oil prices has been about as boring as I remember. And I've been dealing with oil prices since the 1980s. You know, you think about the history of the last 20 years, starting around 2005, you had the climb, the steady climb that led to the inflation-adjusted high price of 2008. Then you had the financial crisis, which of course sent oil prices down. The climb started again up till about 2014. Then you finally had the impact of U.S. shale production, which sent prices plummeting further with the pandemic. Then came out of the pandemic and they soared. You're paying more than $5 for diesel. And then since then you had the Russia-Ukraine war. And then the last year, it's been incredibly steady. This is the price of ultra-low sulfur diesel on the CME commodity exchange. And you can see this is not volatile at all. A low of maybe $2 and a high of around $2.60. That's nothing compared to some of the movement that we've had in recent years. So why have we had this? Zach, can you change the slide? This is the projection of global petroleum supply and demand from the International Energy Agency. Really, it's been fairly well balanced, which is one of the reasons why prices have held steady. However, there are a couple of things here. The reason it's been balanced is really two things. Number one, when the IEA says that, let's say, global production, we'll take that far number, is 102.3 million barrels a day, that's not just crude, that's also natural gas liquids like ethane, propane, and butane. The United States is absolutely far and away the largest producer of NGLs in the world. So you can see the balance, supply-demand balance looks, fairly steady there. And one of the reasons is that OPEC Plus, which is OPEC plus a lot of other oil exporting nations led by Russia, had done a pretty good job of maintaining their production levels, holding their output down so there wasn't a glut that was developed. Well, in recent months, recent year really, they have decided that they're not going to do that anymore. So what you're seeing here in that last column, you can see for the third quarter of 2025, this gigantic gap between supply and demand. You normally do not see it that big. Maybe during the pandemic, that's it. Now, in that final column of the fourth quarter, the IEA does not project output because it doesn't know what OPEC's going to do, but you can imagine that that gap might be even higher because OPEC Plus has continued to wind down its production cuts. So the G word has been out there quite a bit. That word is glut. And there's an aspect of it, and I don't want to get too political, but I think it's important because I'll bet a lot of people in this room service the oil and gas industry in the United States. It's a global market, but there's a U.S. sector for producing it. And I'm sure that that business has been probably pretty good for a long time. One of the reasons that we've got that, let's say, 107.6 well above demand there in the third quarter, and likely to be even higher in the fourth quarter, is that Donald Trump had basically asked the Saudis to increase their production, to dial back some of their output cuts. Why? Because politically, he wanted lower oil prices. And that's sort of understandable. People like lower oil prices. You have to remember that OPEC has traditionally, people tend to think of it as an organization that looks to drive prices higher. No, their historical role is to manage glut. They take oil off the market or put it back on depending on what supply and demand is. So glut is a very important part of OPEC's job. They're the swing producer. They take the oil off the market if it's not needed. However, by the Trump administration asking the Saudis to put more oil onto the market, they're essentially shifting. I don't think that was their plan, but they've essentially shifted the role of swing producer onto the world's biggest producer. And so next slide, Zach. So you can see this in the oil patch. The layoffs have been high. Production right now is still hanging in there. I will say that. We haven't really seen a drop in that. But you've got the oil industry is seeing its future. It's seeing that it's probably going to dial back production because the Saudis and other OPEC countries are essentially forcing them out of the market. Somebody has to be the swing producer. They are publicly traded companies. They are going to pay dividends. They are not going to do what they did before the pandemic, which is to just drill, baby, drill all the time, produce lots of hydrocarbons, cash flow be damned, dividends be damned. They're not going back to that. So that's why you see these kind of cutbacks. I will say, I will make a political statement. When the price of oil is high, the American people will absolutely hold the president responsible for it. No doubt about it. Just go ask Joe Biden. He'll tell you. When the price is low, I think people expect it. And they don't throw as many bouquets at the president as I think the current administration thinks is going to happen. That's the reality of it. I also want to talk, last point here. Oh. Yes. Okay. I want to talk about this. I talked about this last year for those of you who were here, but I really think it needs to be reiterated, especially because we've had a change in administration in Washington, and that change in administration has come with a lot of hostility toward EVs. You heard some interesting talk yesterday from, I guess, Mr. Who's the head of the beige book? Leyland.
Oh, Miller.
No, I thought
Miller.
so. Okay. About Chinese EV capacity and how much better they're getting. There was a U.S. auto executive who toured China's facilities and said to see their technology is humbling. Remember, as I said before, it is a global oil market. I'm going to date myself here and tell you that it's like a waterbed. Okay, only somebody as old as me knows what a waterbed is. You know, you squeeze it in one place and it ripples through the entire waterbed. So you have, even if you don't have EV growth in the U.S., because we're taking away some of these subsidies, there's a general hostility to it. Some of the U.S. auto companies are pulling back their losses on them. The fact is the world is going increasingly to EVs. These are numbers from China, which is a gigantic market. You look at to see how much their sales and use of EVs has grown just in the past year. The price of oil, really the price of any commodity, but we're talking about oil here. The price of oil is set on the margin. What is the competition for that last barrel sold? It's really like any market like that. As a result of this growth in EVs worldwide, the competition for that last barrel has been less. You are all, I'm sure everybody in this room probably wakes up short diesel. Okay, you are benefiting from this, even if you don't think you are. This has definitely been a factor in holding down the price of oil. That marginal barrel demand is weaker because of EVs. And it's just something, there's nothing you can do about it, but it is a factor in the market, very much in the market right now. I will say this, I started by saying everything was boring. And then today the price of diesel on CME shot up 5 cents. I really don't know why, but it did. Anyway, that's a quick overview of where the oil markets are, and thank you very much.
Thank you all.